August 14th, 2024. Coming into the day, you knew that yesterday was a big bull trend day, a small pullback bull trend day. And when the prior day is a small pullback bull trend day, there's only a 25% chance that you get a second consecutive small pullback bull trend day. So coming into the day, the odds were against some sort of a small pullback bull trend. The odds were 75% chance you're going to get at least 2 hours of sideways to down trading. So it's not, as much as you might want to try and buy in this area, it's not really worth doing. You probably want to wait until you can buy a reversal up from lower. I did mark 10 because I do think it was reasonable, but I think if you took 10, you needed to have a wide stop, probably something like a measure move down and be willing to scale into the trade. I did not personally buy 10. I thought it was, I thought it was okay to do, but the channel down was pretty tight. And so I just didn't really want to do it. But the interesting thing, well, I guess I'll get to that piece when I get here, but we got a measured move today of, you got a leg one, the initial spike. In general, when you get these, this many consecutive bull bars, well, first off, the stat is when you get consecutive bull bars closing near their highs, so 14, 15, and 16, there's a 60% chance you get a measured move up. And if you buy here by the close of 16, you have a 60% chance of making a measured move. Maybe it's a leg one, leg two. Maybe it's just a measured move up like that. You have still a 60% chance of getting a measured move up on the close of 17, but now you have a 60% chance of getting a measured move up of this. So if you buy this close, and as you get these, the odds increase that the odds continue to increase. Sorry, the odds stay the same that you're going to make money, except your profit becomes a lot larger. So when you get this, you can see we ended up getting a leg one, and then we got a pullback on bar 20, and then we got a second leg up. So it was a spike, pullback channel. The channel was kind of its own spike, and it was a wedge, 1, 2, 3. So it was a bit of a parabolic wedge channel. Sorry. This is the wrong measure move. Give me a second. It was with tails. That was bad. There it is. That's what I was looking for. So we got a leg one, pullback, leg two, measured move, and that's about where we reversed. I think one of the reasons we reversed is because most traders knew it was not going to be a small pullback bull trend day because the prior day was. So the odds of a small pullback bull trend were really not all that great. Bar one, a reversal bar, a big bear reversal bar, closing near its low. It's a failed breakout of yesterday. You could argue it's a wedge, 1, 2, 3, 1, 2, 3. Either way, it's a bull channel line, right? We have a spike in a big bull channel. And it's failed breakout above the bull channel and a reversal down, and it's a pretty large bar. So I think it's reasonable to think that bar one has a 30% chance of being below the high of the day. You can definitely short bar one and take it for maybe, I don't know, look for 10 to 15 points, 10 to 20 points maybe. But I did not personally do that because I try not to trade the first 5 or 6 bars of the day. I try to wait for a little bit more information. I don't always make it the whole 6 bars without taking a trade if there's something that looks really good, but it has to be a very specific context and for me to do something like that. But I thought it was reasonable to sell below 1, taking a chance that we had seen the high of the day. Bar 2, a bull reversal bar. So the bulls are hoping that the gap up is a new bull trend, and this is their high 1 on bar 2. The big problem, obviously, is that it's a reasonably big bar. The context is terrible, right? You don't want to be buying up here. This is probably more of the sell zone. This is more of a trading range. Bears, maybe they don't want to sell directly below 1. They'll look to sell a 50% pullback instead. Around here, you can see it hit that price, but it did not go one tick past it. So some bears got filled, but not all of them. Additionally, something else to note, 2 to 1 of your true risk of selling 1 is a 10-point or a 10-point trade. So that's not a coincidence. The traders sold the 50% pullback, and they knew that from this low, or at least the algorithms, it's not a coincidence that the algorithms put the 10-point scalp there and they put the true risk at that exact area. So the traders, they're selling a 50% pullback, trying to make basically 15 points from the middle of this, risking 5. So they don't have to win all that much of the time in order for this to be a reasonable thing to do. But it is a reasonable thing to do. So that's why a lot of traders were taking that short. What I was saying is it's not a coincidence that bar 2 pulled back 5 points and created the 10-point scalp for selling below 1. That's just what the algorithms do. Bar 3, a big bear bar, but a tail on the bottom. It's really not all that great. The bulls are hoping this is a second leg down. So 1 pullback on bar 2, and then bar 3 is the second leg down. And they want some sort of high 2 on the open. But I'm not that bullish. To me, I think we're forming a trading range, and I want to look to buy low in the trading range once I think the trading range has established itself. So I'm not trying to take a chance on the bull side. It's reasonable to look to take a chance on the bear side here, but again, for the bulls, you don't really want to be taking chances in this area. So the bears are hoping it's a continuation of the breakout and that we're going to continue down. Excuse me. And break far below bar three. Not sure we're going to. To me, this looks like it's going to end up being a little bit more sideways. Bar four, an inside bar, big tail on the top and a tail on the bottom. What do you do with four? Nothing. It's a low one short for the bears. So they have a new breakout, bar three, closing below the moving average. Good for the bears. And then bar four, a low one short. But do you want to sell below bar four? I don't really. There's a huge tail on the top and a huge tail on the bottom. And it's a bull bar. You don't want to sell below a bull bar towards the bottom of what could be, a trading range. You don't know that where the low of the trading range is yet. Usually becomes pretty obvious once it forms. Like when you see 14, it's rather obvious that this is probably the bottom of the trading range. But like I was saying, it's not always so obvious when it's forming in this area. So you don't really know if four is the low of the trading range, but it's not worth taking a chance buying anything in here. It's not worth selling, taking a chance we go lower. So I don't think there's anything to do. Five, another inside bar. So we have an II pattern, which is a breakout mode pattern. Do you sell below five? I probably would not. You probably can, but you need to have a really wide stop. I think the only really credible trade so far on the day is selling below one or selling the 50% pullback of one if you're a limit order trader. So bar five, an inside bar. The bulls are hoping it's a final flag for the bears, and they see three pushes down, 1, 3, 5, so possibly a parabolic wedge. The bulls are hoping that the Bears. The Bears are hoping that we get this is an II and a low one short, and we get a big breakout to the downside, start a big bear trend. I think it's probably more likely that the bulls have a more credible argument. However, I don't think the bottom is in. You can see bars 1 through 5. We have not traded above the prior bar yet so far. So we have a 5-bar micro channel down for the Bears. So as much as it is probably a parabolic wedge forming, and this looks like a trading range, it doesn't look like a strong trend in either direction. I think it makes the most sense to just be on the sidelines right now. Bar 6, bear bar. Yeah, technically follow through for the Bears. Tail on the top, tail on the bottom, though. So I don't know. You see 6, and if you didn't sell below 5 and you were thinking about selling below 5, you look at 6 and say, dang, I missed out. You know what I mean? You're not thinking that. To you, it's probably just saying, oh, okay. So, I look at bar 6 as kind of a pause bar. It buys kind of the same way I look at 15. Obviously, the context for 14 was much better than the context for 5, but the pause bar is essentially a way of buying time. So when you look at 6, if you sold below 5, let's put it this way, and you get 6, you're not thrilled with the bar. But if you took a swing trade, you're maybe not going to exit. I guess you probably should exit. But my point being that it's more of a pause bar. It's not really good for either side, bar 6. So it really just buys the Bears another bar. So it is consecutive bear bars, yes, and we are always in short. But the Bears need, a dramatic bar. They need something probably like 34 or 13 in order to convince traders we're going a lot lower. And that's what they were hoping for directly below 5, and they didn't get it on 6. And so what they're hoping for is that a bunch of bears will see that who were considering selling below 5 and decided not to will now see 6 and now see, okay, well, now I have consecutive bear bars, so I'm more confident we're going lower, and they'll sell the close and create a really massive bear bar. But it's not all that likely that that's going to happen. Reversal up 7, it's a bull bar, a reasonably good looking bull bar, and the location, it might be good. We might be towards the bottom of the trading range, but after the 6-bar micro channel, 7-bar micro channel, I'm not willing to buy the first reversal up. I don't know if it's the bottom of the trading range. Again, Brad said something like, I think it was like a year and a half ago, I was listening to one of his reviews, and he mentioned it's not always obvious when the market is trying to bottom, but when it does bottom, it becomes very obvious. And I think that saying applies here with bars 7 and 10. It's not obvious that 7 and 10 are, lows, and it seems like the market's trying to make a bottom. But everyone agrees on 14 that the market has gone too far to the downside and that we're getting a reversal up. So you'll often, if you trade for a while, sometimes you'll end up, taking those earlier buys, 7, 10, whatever, that aren't all that good. And then you see 14, you'll say, oh, okay, here it is. But if you instead, when you're unsure of trades like this, just sit out of them and then wait for the one where it's like, okay, now we're doing it. Those are the trades that'll end up probably making you That'll probably end up making you a profitable trader. You obviously have to get good at reading charts, and there's a lot of steps in between that. But once you're good at reading charts and you're good enough at trading that you can, identify the good trades versus the bad trades versus the great trades, and you take the best of the good trades and all of the great trades, or only really, really good and great trades, then that's when you become profitable. So bar 8, a bear bar, sellers above 7, not all that surprising because even though parabolic wedge, 7 bar bear micro channel, so not all that surprising. Bears, we trigger below bar 7, so it's an outside down bar, but I don't think we're going that much lower. You can see the buying pressure on 6, 7, and 8. So bulls are getting buying pressure, and now we don't have a micro channel anymore. It looks like some sort of wedge attempt is forming. 9, a bear bar, but it's not all that convincing. You can see we got bought back up and we closed above the low of bar 8. So I think that's pretty disappointing. If I was a bear and I was looking to short and I wanted to sell the breakout and the breakout closed above the breakout point, I would be rather disappointed with that trade. And a lot of traders are, and they'll buy back shorts, and that's what causes bar 10. Bar 10, a bull bar, it's a parabolic wedge, 1, 2, 3, and then a reversal. And you could argue it's a second reversal up from a wedge. I don't disagree with that. But I think this could also be a spike on 3 and then a wedge channel. So this could be, the way I viewed this today was this was the initial wedge. Then we got a breakout attempt below the wedge that failed and a reversal up. Oftentimes when you get a breakout attempt below a wedge that fails, maybe sometimes you'll get a measured move up of the wedge. And, probably occasionally the whole thing, but that was not the case today. I don't know, maybe we went halfway between them. Not quite. So 10 is a wedge, but I think you're buying too high if you're buying 10. And this concept was confusing to me for a long time, but the more time you spend looking at charts and the more time you spend thinking about it, the more you'll realize that context is what's key here. First off, if you're buying above 10, you're buying right on a flat moving average. So you don't want to do that. That's right off the bat a problem. If you are buying above 10, if you've been watching my videos, I say a lot, you want to buy a small bar up from the bottom of the trading range. And that's true. And if you did, if you took it literally where you can only buy in the lower third and only sell in the upper third, you would look at this and say, okay, I'm buying a relatively small bar 10 in the lower third of the trading range. Okay, good. And it's on a flat moving average, and that's not great, but the bars look good. And while some of the bars do probably look good, and it is a reasonably tight channel down, so you do have to consider that. The big thing for me was I was not that bullish on this day because the prior day was a small pullback bull trend day. So I'm expecting a couple hours of sideways to down trading. So for me, if I'm going to buy a reversal up, I want to buy a reversal up from way low in the trading range, like we got on bar 14, and after a climactic bar, on bar 13. So you have this big sell climax, bar 13, trapping the bears in who sold the breakout, and then you have a reversal up 14, and all the bears, you can tell, and any bear who shorted here or sold the close of 13, sold below 13, whatever, sees 14, and they're thinking, that's not what I wanted to see. And so those bears are going to be getting forced out and stopped out all the way up. Here, you just don't have a lot of trap bears. So, for me, I would rather wait until I have some trap traders. And you're buying, and your risk is reasonably big, and you're within this tight trading range from bar 6. So, as much as bar 10 is a small bar in the lower third of what might be the trading range forming, we could test even lower. Remember, this area is the bottom of the trading range from yesterday, and this might be the top. So yes, you might like the fact that you're buying above 10 and it's lower in today's range, but if you look at the past day, maybe it's more towards the middle. That might be actually what's going on. And 14 ends up being in the actual lower third. So you have to keep that in mind. 12 or 11 consecutive bull bars, 10 and 11, good and closing near their highs. It's a trend line break from for the bears for the bulls of the bears. So it's a trend line break, good for the bulls, 10, 11. Consecutive bull bars were probably going higher, but I'm not quite sure I want to buy 11. I think I want to rate, at this point I was hoping we would get a pullback. This was lucky, I think, for the bulls that we pulled back this far, got this good of a looking of a reversal up. But it doesn't usually quite happen so clean. But either way, consecutive bull bars, 10, 11, we might be always in long. We probably need one more bar, I think, at least. But I think we're going a little bit higher, at least. This should get a second leg up. One of the reasons why this reversal is really good is because you get all these good-looking bull bars. So when you have all these good-looking bull bars, it increases the odds of a swing up at some point today. I want to see if 12 was a 50% pullback. It was around a 50% pullback. So the bulls, they see 9, 10, 11, and they say, yeah, good for the bulls, but I think I would rather buy a pullback. My risk is relatively large. So 12 dipped down and traders bought the pullback. It's important that 11 never triggered above 12. A lot of the bears, they sold the close of 11 with a stop above it, trying not to let it trigger and trying to drive us down for at least one more leg. They were hoping for a breakout below the wedge and a measured move down. You can see they got the breakout below the wedge, but it never got any follow through and obviously never got a measured move down. So we're in a trading range. So the bulls who are buying the 50% pullbacks of 9, 10, 11, and you get a 50% pullback 12, they buy it and it rallies. What are they hoping for? Well, first off, they're probably scalping. It makes more sense to buy the 50% pullback and then they sell out of the long around the bar 11 close, which is contributing to this. A lot of this might be bull selling for a lot of reasons. And that would be one of them. Buy the 50% pullback, you ride it back up, and then you exit around the close of 11 during 13. And some of them, maybe they were hoping, they're being optimistic and hoping that 12 ends up being a bull close and they can potentially get a swing trade out of it if they have 3 straight bull bars. However, it ends up being a bear close. So that's not as good for the bulls. 13 is obviously a surprise. You're not going to predict 13. It's not, well, it's not dumb to sell in a limit order around the close of 11, but I think we're probably always in long. So, it's okay if you missed out on this. It's really hard to get in on this kind of stuff. This is really, I think this stuff is like one of the last things that you really get confident in is selling as the market is collapsing and taking a scalp. It's something I have a lot of old recordings of Al in the trading room. One of the ways I study, you can buy it for like $100. You can buy like 3 months worth of recordings. It's like 100 hours of study material for $100. It's a really good deal. But anyways, a lot of things he'll talk about as he's trading is he'll take trades like this where as the market falls, he sells. But, I think that for most traders, especially traders who are not yet profitable, just stick to stop orders. And, I'm a hypocrite in saying what I'm about to say because you listening to this video, you've done this before. I've done it before. Everyone's done it before. The reality is the easiest way to become a profitable trader is to only buy on stop orders above good looking bull bars and only sell on stop orders below good looking bear bars. However, everyone listening to this, myself included, has taken limit order trades a couple of times, many times, and probably lost a lot more on limit order trades in spots where they just should not have been trading on limit orders because, the limit orders are enticing. And the problem with trading on limit orders is you'll win a couple of times. That's, I think, the big issue with trading on limit orders is that you'll win a couple of the trades and then you'll gain a little bit of confidence and increase your position size in them. And then you take a big loss that more than erases all of your wins. It's the same. It's the problem is that you're trading high probability trades. So, even if you're not trading in a way that is profitable, you might still be trading in a way where you're winning 65, 70% of the time on your limit order trades. Probably less than that. Probably like you might be trading in a way where you're winning 60, whatever, such percent of your limit order trades, but your risk reward isn't very good. And if you're used to trading on stop orders where you win maybe 40, if you're good 50% of the time, you start winning 60% of the time and you think, wow, this is awesome. This is fun. I think I'm good at this. But the reality is you just changed your risk reward profile. You didn't just magically get good at limit orders overnight if you haven't mastered stop orders yet. So anyways, 13, a big bear bar closing near its low. It's a bear surprise. It's probably partially due to bears and partially due to bulls. Obviously, anytime you get something this big, what it really is for the bulls, they're hoping, well, what it is for everyone is a breakout attempt below the wedge, right? You have a wedge, 1, 2, 3. It's pretty clear. And the bears are hoping we get a big bear breakout. 13 does a good job of reversing 10 and 11. However, we're getting enough good bull bars that I think we're going to get a bounce. So the bears really want a follow through bar on 13, but I don't know if they're going to get it. And it turns into an immediate bear trap and a reversal up on 14, which is really disappointing, I think, for the bears. I didn't add this to my traps file. So reversal up on 14, failed breakout below wedge. You can buy above 14. My only issue with 14 was the tail. So it doesn't look like much, and it's not much. This is how I traded this anyways. It's important to stick to a plan if you're going to try and, create plans. So I bought above 14 and I decided that I needed a really good follow through bar because I thought the micro gap down was disappointing. And I thought it was, the tail was just a little bit larger than I wanted it to be. It wasn't perfect, but close is close enough. So I bought above 14. I just basically said to myself, I wanted 15 to look the way 16 looked. and said, if it doesn't look like that, I'm just going to exit the trade, and then I'll buy again if there's a bull bar closing near its high. So I got 15, and I just decided to exit the trade and wait for one more bar. And if we got one more good looking bull bar closing near its high, then I would just buy that bar. And the reason being for that is, if you just think about it from an emotional perspective, if you bought above 14, you see 15, you say, okay, that's fine, but it's not really what I wanted. And then if you see 16, if you bought above 14 today, you probably saw 16, you thought to yourself, oh, I'm probably gonna make a lot of money on this trade. And so why not just wait until you have that, oh, I'm probably gonna make a lot of money on this trade feeling to enter the trade. It's natural to want to enter trades early, but if you just resist that temptation and let the market go in your direction a little bit, because I remember I used to get upset if I would buy above 14, exit on 15, and have to be buyback later on 16. I'd be upset because I just missed out on some money. But it stopped upsetting me a while ago when I started to realize that it just means I'm more likely to make money. So I'm totally cool with the fact I'm glad 16 looked the way it did after I exited, because it gave me a higher probability trade and it let me back into the trade, and I ended up obviously doing pretty well in the trade. So don't be upset about missing a little bit of profit. Don't be upset about pennies when you're about to make dollars. Is probably the point. And you don't have to try and save yourself, whatever 6-7 points when your potential reward is 15 to 20, things like that. 15, so obviously bear trap, breakout below the wedge, failed breakout below, and a reversal up. 14, bull bar closing near its high. 15, consecutive bull bars, but a tail on the top, not really what bulls wanted. It's possible we get one more leg down, but this can still pretty easily be a bear trap. 16, 3 straight bull bars closing near their highs. Good for the bulls. I think we're going higher. How much higher? Well, we're about to finish forming the 18 bar range, so I think we're at least going here because we're always in long. And we probably should get to the high of the day since we're going to break out the 18 bar range. This is a sell climax, so it's less necessary for this low to get tested because it's really not a very reasonable thing to do to sell the close of 13. Obviously, the sell climax high is going to be a magnet, and there might be some profit taking there, but there's only reasons to buy here. There's no real reason to sell. You could look for a measured move up of the sell climax. You could look for a measured move up of this. Either of those is a reasonable thing to do. Buy the close, 14, 15, 16. 17, a bull reversal bar. So bulls bought a pullback near the moving average and reversed up into a bull bar closing near high. 17, good for the bulls. 18, another bull bar, a tail on the top and a tail on the bottom, but still always in long, still buy the close. 19, another bull bar closing near its high, still always in long, still buy the close. No reason to do anything except for be buying in this area. This is a really strong spike, and it's going to get a second leg up. This might overall be a trading range still because of how strong this was, or it wasn't that strong, but it just, first 13 bars of the day, sideways to down. And then this was really, really dramatic. So we are always in long and we're probably going higher, but you do have to keep that in mind. Outside bar 20. So outside down, but very, very, very high probability that there's going to be buyers below 19. So because after 1, 2, 3, 4, 6 straight bull bars, we're most likely going to find buyers below and at least get a second leg up. 21, an inside bar, so a high one for the bulls. It is a high one towards the top of a potential trading range, but the reality is if you buy here with a relatively wide stop, you're probably going to make money. If it's a spike in channel, we probably should not. Sorry, I just got a text. We probably should not fall too far below here. So a spike in channel is, very possible here. And if you're betting on that, you have to consider the fact that, this is kind of what I was thinking about yesterday. If you're buying here, your premise is it's a spike in channel. And if it's a spike in channel, how far down can the market fall where you can still say, I think this is a spike in channel? If it falls below 18, so you buy here, your premise is spike in channel. If it comes down here, do you still think it's a spike in channel? Probably not. Even if it falls below 20, do you still think it's a spike in channel? I don't know. Probably not. Yeah, I probably wouldn't put a stop below 20 until we start getting above this area, like until we get 24. Then you can put a stop down here. But I don't know. I don't think a stop, maybe below 17 is unreasonable, and you just look to get out pretty quickly if it starts to go against you. 22, a bull bar, but a bear bar, but a doji bar. Really not all that good. You have to keep in mind, if we're starting the channel phase, it's not going to be as strong as the spike phase because the market gets weaker as it continues to rally. So good spike, yes, and then a pullback, but we'll see if the channel phase ends up being all that good. It's probably going to be, again, you know, spike, channel. So spike, pullback. Obviously, this ended up being a little bit stronger, but you should be expecting it to do more of this and less of this. 25, a doji bar. So we have consecutive doji bars, 23 a doji bar. So we have consecutive doji bars, 22, 23. I don't know how much higher we're going. There's probably going to be sellers not too far above and buyers not too far below. Then a surprise bull bar, 24. Reasonable to be looking for a measured move up, I think, at this point. And just hold and keep your stop, moving your stop to the higher lows and see what you get. Maybe exit at a certain number of points. I thought looking for 20 points was reasonable on this day, and I would not be buying up in this area. You can see it was a wedge, 1 pullback, 2 pullback, 3, or you could say spike and then wedge channel, 1, 2, 3. All of those were reasonable things to do. 25 is the breakout bar. So I think once you get 24, it's reasonable to trail your stop in this area. And then 25, a big bull bar, but a tail on the top. Created an open gap with the high of the day. The traders who sell above the high of the day, they're betting that this is going to be a trading range day and that if they scale in, they're going to be able to make money, which was true. If they sold and they scaled in, they were able to make money. So that's what the traders selling up here are betting on. And the bulls buying up here, they're hoping for at least a little bit more higher. They're not necessarily hoping for a bull trend, but they still know that this is likely going to create some sort of measured move. So they're going to be looking for that. I don't know. Did we get this measured move down? Is that where we stopped? Sometimes the market will do that with the last leg. It'll create a measured move in the opposite direction. Or spikes in general, any climactic bars. Anytime you get this bar, doesn't mean when we start to rally, it doesn't mean just forget about 13. The measured move up of 13 is still going to be relevant. So sometimes, if you get a big bar like this, odds are very high you're going to get a measured move of the bar, or it's a 100% chance that in either direction you're going to get a measured move of the bar, obviously, because the market's not going to stay within this range forever. But odds are you're going to get a relatively aggressive rally, a relatively aggressive sell-off towards that measured move. 26, another bull bar. So tail 25, tail 26. You can see bodies are shrinking and we have bigger tails, so it might not be as bullish as it was, but still reasonable to be long, always in long. 27, a big bear bar. To me, this is you get out below 27. It's a big enough bar that it's probably going to get a second leg sideways down, and we're probably going to close the gap with the bar 1 high. And everybody knows that the bulls are going to get out below 27, and the bears are going to try to flip the market always in short. When you see 27, we're probably about to get a couple legs sideways to down. So what do bulls do? They buy the close of 27 aggressively, trying to run the market back up to the bar 26 close. They'll buy, and they'll put a stop below 27, risking, basically 2-3 ticks, trying to make 4 or 5 points. And obviously, when you have, 10 to 1 risk reward, you don't have to win that much of the time. And, I don't know, maybe 30% chance, 35% chance that they're going to be right doing that. So, you only have to win 10% of the time to break even. If you're winning 30% of the time, you're probably doing pretty well in the trade. 28 rallies up to around this close, where most of the bulls who bought in this area are just looking to scalp out. Who's holding up here and who's buying? The traders, the swing traders. It was reasonable to just put your stop below here to get out and then sit while this rallied, and you could have just let it keep going. Or you could have exited here. Neither one of those is wrong to do. 29, another bull bar, a bull bar closing reasonably near its high, but a tail on the top. Again, I think we're going a little bit higher, but I'm not sure how much higher. This is getting pretty extreme. 30, another bull bar closing reasonably near its high. But again, a big tail on the top. We have tails 27 or 28, 29, 30, and we have tails here. So none of these bars really closing on their highs, but still always in long, still reasonable to be long. 31, another bull bar, but you can see how much less momentum we have with 31 than we had over here. And then a reversal down 32. 32, I would not personally sell 32. You probably can. It's a wedge, definitely. I get the logic, and you're betting on a trading range day and you're betting on the gap closing, but I don't know. I just personally do not like when I see this as this is happening, my mind is just in buy mode. So, it's not wrong, I don't think, to sell below 32, but I didn't mark it because that's just, I think, when you're seeing this happening, your brain should be saying buy, 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 buy. And then you should be getting out here, which part of the reason it's a reasonable sell is because, the bulls are going to exit below the wedge. But I think it's just more, I don't know, what's the word I'm looking for? It's smarter to look to trade with the trend rather than try to pick the top of the trend and look for the reversal. So 32, bulls will exit. It's a wedge top. 33, more follow through for the bears, but a tail on the top and a tail on the bottom. Some bears, they wanted to sell 32, but they were scared it was going to be a trap and it was, going to go outside up or something like that. So when they see 33, they now have consecutive bear bars and they're more confident that the market's going to go in their direction and they can get in at basically exactly the same price. So they'll sell the close of 33 with a slightly higher probability. And that's part of what's causing 34. Also, there are bulls who held below 32, hoping that it's going to be a trap. And when it's not, they're disappointed on 33. They exit at the market. And that, again, is causing 34. 34 is the bulls giving up. To me, 34 signals this is a trading range day. And if it is a trading range day, some traders will sell the close of 34, trying to make, I don't know, what's the little over a 5-point scalp to the bar one high. Some traders look to sell some more of a pullback. I don't think we got to 50%. We did not get to 50%. But some traders look to sell as 35 is pulling back, betting that we're going to get back to this high because it's very likely we're going to, because this is now a trading range day. Huge bear bar, 34, 35. We're definitely going at least a little bit lower, but big tails on the tops and bottoms of 35. So again, good for the bears, huge bear surprise, but I don't know how much lower we're really going. 36, disappointing, but a big tail on the bottom. Probably sellers above, scaling in higher. Obviously, this is going to get a second leg down. So 37, a good looking bull bar, but a tail on the top, tail on the bottom. I think this is going to get a second leg down, but I'm not sure how much we're going to rally here. 38, a bull bar, so consecutive bull bars, 37, 38. Probably going to go, probably not a big bear trend forming, probably just a trading range. It's an aggressive leg in the trading range, yeah, but I don't think it's going to be all that great. 39, outside down, good looking for the bears, but again, might just be somewhat of a second leg trap. This is a first leg, if you think about it. So first leg is the wedge, breakout below is the second leg. So it's a second leg trap on bar 13. I'm going to actually add that. So first leg pullback, second leg. First leg pullback, second leg trap, 39. Reversal up 40 is a high 2. Good for the bulls, but I don't know. I'm not buying above 40. I'd rather just wait, see what happens. It's not the best trade of the day. It's not even one of the best trades of the day, so not really worth doing. 41, a bull bar closing near its high. It's good for the bulls. At this point in the day, what are you looking for? Well, the bears want a lower high major trend reversal, which they got an attempt at it on 54, but obviously it ended up failing. It wasn't a very strong major trend reversal setup either, but that's what they wanted. What do the bulls want? Well, the move from 14 to 31 is really strong, so it's probably going to get a second leg up. 42, 3 straight bull bars, good for the bulls. Probably buyers not too far below, probably sellers not too far above. You can see we got buyers below 42 during 43, probably expecting a second leg up. 44, a bull bar, but a tail on the top. 3 straight bull bars, 40, 41, 42, and second leg up, 44. Probably going at least a little bit higher, but I'm not sure how much. You can see buyers below 44 during 45. And then we entered a tight trading range. It is a bull channel and it's a spike 40, 41, 42, and then a channel up to 54. And it's obviously a wedge for the bears, 54. And you can say all that stuff, and I could go through and say buyers below 44 and sellers above 45. Bad high one for the bulls, 45. I'm probably, I guess I'm going to, but the thing to keep in mind is when the market starts doing this, just don't trade. There's no reason to trade in here. This is not good price action. And if you're trading in here, you have to ask yourself why. Like, do you think anything in here is going to be the best trade of the week, the best 5 trades of the week? Probably not. So I don't really think it's all that great. I would just rather be flat. You're probably trading towards the middle of this trading range as well, this leg. So it's just really not that good. And there's just all these doji bars and we're right on a flat moving average. So I just personally do not want to trade in this area. 40, so buyers below 46, scaling in, disappointment 47, outside up 48, follow through 49, reversal down 50, possibly a wedge 39, 44, 50, 50, and then 51, 52, 53, good for the bulls, and then reversal down 54, an inside bar. If you sell below 54, I probably would not. It's a lower high major trend reversal, yeah, but I think it's just better spots to put your money in. 55, consecutive bear bars, but a big tail on the top. So again, if you were selling the lower high major trend reversal, you wanted really good follow through, and instead you got 55, huge tail, disappointing. So that's probably part of the lack of momentum on 56, 57, and 58. And then 59, bears buying back shorts, causing a big bull bar. And then 60, an inside bar, high one for the bulls. Bears are going to exit. I was looking to buy in this area. I did not buy above 60. It's fine. You can do it. But I still was looking at the trading range, and I wanted to see what the breakout above the wedge looked like. So I wanted 61 to be a good looking bull bar, like 66 was, and get a strong breakout above the wedge. And then I was going to buy it. But instead, we got 61, 62, 63, which is still good. It's still 5 straight bull bars. You can buy, there's going to be buyers below 63. You can see there was. So it was reasonable to buy below 63, but disappointment 64, and then rally 65, 66. And you can see 65, 66, as strong as they look, it's just a vacuum test of the bar 33 low. So dump 40, 34, 35, and then the rally was vacuum test of the 33 low. Reversal down 68, or inside bar 68, high one, sellers above. Sorry, inside bar 67, high one, sellers above, reversal down 68, 69, huge bear bar. And then basically high two, 74. But I don't know. You can buy the high two, but I would personally just be done for the day. Once I started, I was sitting here during 62, 63 and was kind of looking to buy. And then I kind of just said to myself, even if I get what I'm looking for after these doji bars, it's not really all that great. So I would rather just be done for the day and wait for tomorrow. So that's what I did. So stop orders on the day, sell below 1. You can buy above 10 with a wide stop, I think, but it's not the best trade. 14, yes. Failed break below the wedge, reversal up. 16 by the close, 17 by the close. 21. So 18 and 19 also by the close. 21 you can buy. 24 by the close, still 25, 26, but climactic. I would not buy. After 27, I would probably just, if you're long, you can keep, a piece long, but I would probably be looking to get out up in this area. You could probably sell 32, but I'm just not going to personally. Sell the close 34. And then second leg trap 39, so maybe 40, but I'd rather leave it alone. And I would not do anything else besides maybe buy above 60. You can probably sell below 54 because lower high major trend reversal. I get the logic if you did it. But to me, I see tight trading range and right near flat moving average. So I'm not doing it. 60 you can buy. And then you can see rally back up, backing test of the 33 low breakout point, and then high 2, maybe. You can probably sell 68, but I just wasn't here, so I was all done with it. And you can definitely take the short, but I don't know. I'd probably just rather sit out of it. I really like trading the open. I actually found, it was kind of funny, of the past, basically 10 trading days, I have bought the bar that was the low of the day, or sold the bar that was the high of the day, like 6 or 7 out of the 10 days. And I'm very confident in myself in the opening range, and I've my winning percentage, just even over the course of months, is very high in the open, and then it gets a lot lower towards the middle of the day. So all that, my point in saying all of that is find the time of day where you seem to make money. And I stopped. I kind of get really resistant to trading once we start to go sideways. I get really, really, really resistant to trading, and probably usually just walk away. I'm a lot better at trading on the open because it's more volatile, and it's easier to make swing trades and find swing trades. 90% of days have a swing in the opening range, and Al always says, the first way you become profitable is you focus on trading the open and focus on the opening swing trade, and it's kind of funny because the longer you trade, the more you start to hear things differently. There was probably like the 5th thing I read in the book that you're supposed to look for the opening swing trade, and it takes years to just start to look just for that. And if you get it, then great, and you just become resistant to trading. But I've been doing extremely well over the past little over a month or two, when I'm pretty much just looking to trade in the opening range, and I tend to do a lot better. So anyways, personal tangents aside, good for the bulls. So we have a breakout above this triangle, and they're hoping for a measured move up of it. Bears, I don't know, maybe they're looking to sell a 50% pullback. I think we went past it. Yeah. What would be interesting, so this is a leg 1 potentially, and it's going to get a second leg down, right? But where's the second leg down going to go? Maybe 5,000. So I will be interested to see if we pull back and it's at the top of the sell climax. I'll be interested to see if we pull back to this area and then start the second leg down towards here. Obviously, this is a really tight channel. It's going to get a second leg up. So we might have to go sideways first, but I'll be interested to see if that happens. And the weekly chart, if the bulls get consecutive strong bull bars here, again, I don't think this is a bear trap. I think it's too strong to be a bear trap. I think we're probably going to end up going sideways in this area for quite some time. So yeah.